In life, there's a blueprint for everything. There's no need to start over. Hear from industry leaders, those at the top of their fitness journey, and real estate gurus. They tell you exactly how they did it. All you have to do is listen, learn, and execute. This is The Blueprint with Brad Rice.
All right, guys, we're back to another edition of The Blueprint, and I'm here to talk to you just myself today because I want to cover everything about 50-year mortgages. That's right. Everyone is panicking about the 50-year mortgage. But when you break down the real numbers, it's really not as scary as people think. So I'm going to go over the real numbers today with you, and let's take a look and compare to what people are saying and what the reality is. All right. A 50-year mortgage really isn't about extending out the amortization. Let's start there. That's not what this is about. It's about getting people to qualify for buying a home when they otherwise cannot with other products. Why are we talking about 50-year mortgages today anyway? Because housing affordability is at its lowest. Interest rates are higher. Home prices are very high, and it's hard to get into a home. It's hard to qualify. First-time home buyer, the age of the first-time home buyer has now increased to 40 years old. Now let's start with, before I give you the numbers, the potential rate spread for a 50-year loan. So the more risky a loan is, the more investors charge for it. So we anticipate that the 50-year mortgage will actually be at a higher interest rate. The difference today between a 30-year amortization and a 40-year amortization is about 0.5%. So for purposes of running numbers, I'm going to add another 0.25% to that. Now, the reason, like I said, that lenders would offer this mortgage is not to save people money. It's really to help them to qualify, bring their debt to income ratios down when they otherwise wouldn't qualify. So let's look at this. If you take a loan amount of $540,000 and we use that as our baseline, and we run 30-year amortization at an interest rate of 6.5% today, that will give you a monthly mortgage payment of $34.1317. The 40-year loan would be 7%. That's at 0.5% higher in rate that I mentioned. And that monthly payment would be $3,355.73. Now let's compare that to the 50-year. At 7.25%, the payment would be $3,352.83. So as you can see, extending from a 30-year mortgage to a 50-year mortgage really isn't about monthly savings. It's only $60 a month. It's about qualifying for the loan. And people may not think that $60 a month will do it, but a lot of times you are that close to getting the exact loan you need or the loan amount you need to win a property. Now, I know what you're going to say. People will say, well, look at all the interest you're going to pay over the term of the loan. Well, let's break that down as well. The 30-year mortgage at 6.5%, if the loan was kept for 30 years, you would have $688,740 of interest payments. The 40-year mortgage at 7% would be $1,070,750. And the 50-year mortgage at 7.25% would be $1,471,698. So yes, the 50-year mortgage nearly doubles the amount of interest you pay over the term of the loan. But guess what? Almost nobody carries one loan, the same loan, for the entire term. Let's look at those numbers. Here's the truth about how long people keep their mortgages for. The average term of a real estate loan is actually 6 to 8 years. And during refi cycles, it drops below 4 years. Even in the high rate era of 2023 to 2024, we're estimating about 10-year longevity on a loan. Almost 85% of people will sell, refinance, move, or restructure their loan within that 10 years, long before any amortization numbers really mean anything. But for argument's sake, let's look at a 7-year comparison and what the payoffs look like at the end of 7 years for a 30, 40, and 50-year mortgage. The 30-year mortgage at 6.5% would leave you a balance of $499,140 at the end of 7 years. The 40-year at 7%, $519,980. And the 50-year at 7.25% would be $527,310. So the difference between a 30 and a 50-year loan at the end of 7 years is roughly $28,170. That's it. So let's face it, people are freaking out about the amount of interest you pay over the term of the loan. But if we realistically look at the 7 years you'll keep the loan, it is not much at all. We're talking just over $28,000 in a 7-year period. But now let's look at real numbers. We're talking about appreciation versus amortization, because the real reason to buy a home now is to build on the appreciation over time. And the average appreciation over the years is about 4.3%. But for comparison's sake, today I'm going to use 3.5% average appreciation. Let's use a home price of $600,000. Appreciation at 3.5% for 7 years would give you a future value of $763,600. That's appreciation gain of $163,600. Compare that to the $28,000 of extra interest you're paying over the same period. No brainer, right? So to recap, even at a modest 3.5% appreciation rate over 7 years, gaining $163,000 of appreciation versus $28,000 of interest that you're paying, and mind you, take into consideration, a lot of that interest is tax deductible. Talk to your accountant about that. It's a no-brainer. The real play here is getting people into homes so they can realize that appreciation and the gain of wealth. I'm going to compare this to another loan product for you, interest-only loans. They've been around forever and they're still widely used. In fact, interest-only loans give you no amortization or principal reduction over the period of time you have them, and typically that's 10 years. And IO loans are used everywhere, including non-QM. So if the market already accepts interest-only loans that give you no amortization over 10 years, why would it not accept a 50-year mortgage that gives you some amortization? Again, over the same period of time, it's not likely you're going to keep that loan longer than 10 years, and most of the time, much less than that. So who benefits from this mortgage product? First-time buyers that live in more expensive markets. Borrowers with stable but growing income. Younger borrowers who need the cash flow. Families that need that lower DTI or debt to income ratio to qualify for the loan. People that plan to own their next home for 5 to 10 years at the most. And investors that need the cash flow to justify the purchase of that rental property. So as you can see, this is not a forever loan. This is just a tool. A 50-year mortgage isn't meant to save you money. That's not what it's for. It's to help people to get into a property they otherwise couldn't afford. So if you break down the real numbers like we did today and you really take a look at it, and I don't care if you use the numbers we did at 600,000 or you raise those up to 800 or 900,000 or you drop it down to 200 or 300,000, they're all virtually the same. If a 50-year mortgage helps people to get into a home they otherwise would not be able to get into, they're not going to keep that loan for 50 years. It's just going to help them to get in and achieve financial benefit from the appreciation of that property. So that's your lesson today on the 50-year mortgage. I hope it helped. Tune in next time. Thanks for joining us on The Blueprint. Like, follow, share. We really appreciate all that stuff, and we'll see you next time.